Hey everyone, it is me again. Today, I want to talk about something very personal, something that still stings a bit when I think about it. But it is super important to share. I want to tell you about how I lost a significant chunk of my hard-earned savings, all because I fell for the traps that many young people, including my past self, often do. It is not a story I am proud of, but it is a story that needs to be told, especially if you are in your 20s and just starting your financial journey. I remember being in my early 20s, fresh out of college, and brimming with ambition. Like many of you, I had big dreams. I wanted to make money fast, to escape the usual grind, and to build a comfortable life for myself. The idea of slow, steady wealth accumulation felt, well, too slow. I was constantly bombarded with stories of people who made fortunes overnight, and I thought, why not me? I did not have a lot of guidance back then, and my family, bless their hearts, did not really have much experience with investing beyond traditional savings. So, I was pretty much on my own, navigating a world I knew very little about. My first big mistake was believing in the hype. I saw these ads, these social media posts, these online gurus promising incredible returns with minimal effort. They painted a picture of quick riches, of doubling your money in a short period, and it was intoxicating. I did not understand that high returns almost always come with high risks. I just saw the shiny outcome and ignored the dangerous path. I was naive, and I was desperate to catch up, to get ahead. I started with what little savings I had accumulated from part-time jobs and some initial full-time work. My approach was simple, if you can call it that. I would follow tips from online forums, listen to whispers about the next hot stock, and basically chase whatever was trending. I thought I was smart, that I was staying ahead of the curve. But in reality, I was just blindly following the herd. This led to a lot of short-term speculative trading. I would buy something because it was going up, hoping it would keep climbing, and then sell it once. I saw a slight dip, usually at a loss. It was emotional, not logical. I was constantly checking my phone, my mood swinging with every market fluctuation. Then came the bigger blunders. I fell for a few outright scams. They were cleverly disguised, promising guaranteed returns, or using complex language that made them sound legitimate. I did not do my due diligence. I did not ask the right questions. I just saw the promise of easy money and jumped in with both feet. Looking back, the red flags were everywhere, but I was too blinded by greed and a desire for quick success to see them. Another major error was my complete lack of risk management. I would put too much money into a single investment, sometimes even my entire savings, hoping it would skyrocket. This is what they call going all in, and it is a terrible idea unless you truly understand what you are doing, which I absolutely did not. I did not diversify. I did not set stop losses. I did not have an exit strategy. I was just hoping for the best, and hope, as I learned, is not an investment strategy. The emotional roller coaster was exhausting. I would get excited when my investments went up a little, then panic when they dropped. This led to what is known as emotional trading, buying high and selling low, which is a surefire way to lose money. I would see a stock falling, and instead of analyzing why, I would just sell it in a panic, locking in my losses. Then, I would see another stock rising and jump in, often right before it started to fall. It was a vicious cycle of fear and greed, and it cost me dearly. Over time, all these mistakes added up. The short-term speculative losses, the money lost to scams, the heavy losses from not managing risk, the emotional trading, it all chipped away at my savings. Slowly but surely, the money I had worked so hard to earn, the money I had envisioned using for a down payment on a house or for further education, was gone. It was a crushing realization, a truly humbling experience. I remember looking at my bank account and feeling a profound sense of regret, even shame. I had let myself down, and I had nobody to blame but myself. But here's the thing about hitting rock bottom. It forces you to reevaluate everything. It was a painful awakening, but it was also a necessary one. I finally understood that the get-rich-quick schemes were just that, schemes. There is no shortcut to sustainable wealth. It requires patience, discipline, and knowledge after that major setback. I decided to do things differently. I stopped looking for quick wins and started focusing on real learning. I devoured books on personal finance, watched educational videos, and followed reputable financial advisors. I learned about budgeting, saving, diversification, asset allocation, and long-term investing principles. I realized that true financial freedom comes from understanding how money works, not from chasing fleeting opportunities. I also shifted my mindset from a desire for immediate wealth to a focus on steady, sustainable growth. I started building an emergency fund, something I had neglected before. I looked into low-cost index funds and ETFs, investments that are designed to track the market and offer diversification. I embraced the idea of dollar-cost averaging, investing a fixed amount regularly, regardless of market fluctuations. This approach takes the emotion out of investing and allows you to benefit from market growth over time. I am not going to lie, it was a slow process. It took time to rebuild my savings, and even longer to rebuild my confidence. but every step I took was a step in the right direction. I stopped trying to beat the market and instead focused on participating in it. I learned to appreciate the power of compounding, where your earnings generate further earnings over time. It is not glamorous, but it is incredibly effective. Now, I am in a much better place financially and mentally. I no longer chase trends or listen to dubious advice. I have a clear financial plan, and I stick to it. I prioritize saving, I invest regularly in diversified, low-cost assets, and I avoid unnecessary risks. I understand that setbacks are a part of life, but I also know how to recover from them and learn from my mistakes. My past self, that eager but uninformed young man, really needed a mentor, someone to lay out the cold, hard facts of finance. He needed to hear that the path to true wealth is often unexciting, built on consistent small steps rather than massive leaps. He needed to understand that real success in finance is about minimizing big mistakes, not just hitting big wins. And most importantly, he needed to learn patience, a virtue I sorely lacked back then. I remember the feeling of euphoria when an investment briefly went up, only to be followed by the crushing weight of disappointment when it inevitably came tumbling down. This cycle of emotional highs and lows was not only financially damaging but also incredibly stressful. It affected my sleep, my relationships, and my overall well-being. I was constantly worried, constantly checking charts, constantly chasing the next big thing. It was an unhealthy obsession that consumed far too much of my mental energy. One of the biggest lessons I learned, and one I cannot stress enough, is the importance of understanding the underlying fundamentals of what you are investing in. I used to buy stocks or crypto because someone on a forum said it was going to the moon, or because a friend mentioned it over coffee. I did not understand the business, its revenue streams, its competitive landscape, or its valuation. I was essentially gambling, hoping that someone else's conviction, or pure luck, would make me rich. That is not investing, that is speculation. And while some people get lucky, most do not. I was definitely in the most do not category. Another crucial realization was that time in the market is far more important than timing the market. I spent so much energy trying to predict tops and bottoms, trying to buy at the absolute lowest point and sell at the absolute highest. It was a fool's errand. Even seasoned professionals struggle with market timing, and for a beginner like me, it was an impossible task. All it did was lead to missed opportunities and unnecessary transaction fees. If I had simply invested regularly in broad market index funds and held on to them, I would have been in a much better position. The allure of leverage also bit me hard. I thought borrowing money to invest would amplify my gains, speeding up my journey to wealth. What I failed to fully grasp was that it also amplified my losses. A small dip in the market could wipe out my entire capital, and then some. It is a dangerous game, especially for those who do not fully understand the risks involved. I saw leverage as a tool for accelerated growth, not as a double-edged sword that could cut just as deeply. The culture of immediate gratification also played a significant role in my downfall. We live in a world where everything is available instantly, and that mindset often creeps into our financial decisions. We want instant returns, instant wealth, without putting in the time and effort. But real wealth, lasting wealth, is built slowly, patiently, and methodically. It is about planting seeds and nurturing them over years, even decades, not expecting a fully grown tree overnight. I also made the mistake of equating net worth with self-worth. When my investments were doing well, I felt successful and intelligent. When they were down, I felt like a failure, a fool. This unhealthy attachment meant my self-esteem was constantly tied to the fluctuating value of my portfolio. It is a dangerous game to play, and it leads to irrational decisions. Your worth as a person is not determined by the size of your bank account. That is a fundamental truth I had to learn the hard way. So what does this all mean for you, especially if you are just starting out? My advice, born from painful experience, is this. First, educate yourself thoroughly. Do not rely on social media gurus or anonymous online tips. Read reputable books on personal finance, take legitimate courses from established institutions, and follow certified financial planners. Understand the basics of personal finance, including budgeting, saving, debt management, and different types of investments before you put a single dollar into the market. Knowledge is your best defense against scams, bad decisions, and the emotional roller coaster. It is the bedrock of sound financial planning. Second, embrace a long-term perspective. Investing is not a sprint, it is a marathon. Do not expect to get rich overnight. Focus on consistent saving and investing over many years, even decades. The power of compounding, where your earnings generate further earnings, works wonders when given enough time. Think about your financial goals decades from now, not just next month or next year. Patience truly is a virtue in investing. Third, diversify your investments wisely. Do not put all your eggs in one basket. Spread your investments across different asset classes, such as stocks, bonds, and real estate. Further diversify within those classes by investing in different industries and geographical regions. This strategy reduces your overall risk significantly. If one investment performs poorly, others might perform well, balancing out your overall portfolio and protecting you from massive losses. Fourth, understand and manage risk meticulously. Every investment carries some level of risk. Your goal is not to eliminate risk entirely, which is impossible, but to understand the specific risks associated with each investment and manage them appropriately for your personal financial situation and risk tolerance. Never invest money that you cannot afford to lose. Set clear limits for yourself, such as stop losses or allocation percentages, and have the discipline to stick to them. Fifth, avoid emotional trading at all costs. Market fluctuations are a normal, inevitable part of investing. Do not panic sell when the market experiences a downturn, and do not get overly excited and buy at inflated prices when the market is booming. Develop an investment plan based on your financial goals and risk tolerance, and then stick to that plan through thick and thin. Make rational decisions based on thorough analysis and facts, not fleeting emotions like fear or greed. Sixth, be highly skeptical of anything that promises guaranteed high returns with little to no risk. These offers are almost universally scams. If an investment sounds too good to be true, it almost certainly is. Always conduct thorough due diligence, ask probing questions, and verify the legitimacy of any investment opportunity with independent sources before committing your hard-earned money. Do not let greed cloud your judgment. Seventh, build a robust emergency fund before you even consider investing. This is foundational personal finance. Make sure you have enough easily accessible money saved to cover at least 3 to 6 months of your essential living expenses. This fund will act as a critical buffer, protecting you from unexpected financial challenges such as job loss, medical emergencies, or unforeseen car repairs, without forcing you to sell your investments at an inopportune time, potentially locking in losses. Eighth, regularly review and adjust your financial plan. Life changes, and your financial goals, risk tolerance, and personal circumstances will evolve over time. Periodically, at least once a year, review your budget, your investment portfolio, and your overall financial strategy to ensure they are still aligned with your current situation, future aspirations, and long-term objectives. Flexibility and adaptability are key components of a successful financial journey. Finally, do not be afraid to seek professional financial guidance. A qualified and ethical financial advisor can provide invaluable personalized guidance, help you create a comprehensive and realistic financial plan, and keep you accountable to your goals. When choosing an advisor, always make sure they are a fiduciary, meaning they are legally and ethically obligated to act solely in your best financial interest, putting your needs above their own. My journey has been a tough one, full of costly lessons and painful realizations, but it has also taught me resilience, the power of perseverance, and the profound importance of financial literacy and discipline. I hope by sharing my raw, unvarnished story, I can help some of you avoid the same expensive pitfalls I fell into during my younger, more naive years. Remember, your financial future is ultimately in your hands. Make informed decisions, cultivate patience, and prioritize long-term stability and consistent growth over fleeting fads or speculative gambles. You have the power to build a solid, secure foundation for your financial well-being. Even if you start small, it is about making smart, consistent choices every single day, not about desperately searching for a magic bullet or a shortcut to riches.